Welcome to The Explainer. All right, so if you've glanced at the charts today, you know it's a bloodbath out there, total chaos. But the real reason for this crash, it's probably not what you're thinking. Let's dig in.
So this all kicked off early this morning on December 1st, 2025. The entire crypto market just started to nosedive. What looked like a little dip at first? Nope. It turned into an absolute freefall, and it caught a lot of people sleeping.
And wow, the damage was swift. We're talking about more than $150 billion in market cap, just gone, vanished, wiped clean off the board in a matter of hours.
So you might be asking, what's the real cause here? Now, some people were pointing to a few minor incidents over in the DeFi space, but honestly, those were just the sparks. The real fire, the massive shockwave, is actually coming from the old school world of traditional finance.
Okay, to really get what's going on, we have to zoom way out from the crypto charts for a second. We need to look at something called the Japan yield shock. I know it sounds a little distant, maybe even boring, but trust me, it's hitting crypto right where it hurts.
This right here, this is the epicenter of the whole earthquake. What you're looking at is the fallout from Japanese 10-year bond yields spiking to their highest level since 2008. Now that might sound like a snooze-fest headline, but it's threatening to completely unravel a multi-trillion-dollar global funding strategy. A strategy that's been propping up risky assets, yeah, including crypto, for years.
For years, this thing called the yen carry trade has basically been the world's cheap money spigot. Think of it like this. It's like getting a credit card with a 0% interest rate and then using that money to go invest in stuff you hope goes to the moon. It was, for all practical purposes, a fire hose of free money just blasting into the market.
And this slide just lays out the chain reaction perfectly. You borrow cheap yen, you buy risky assets like Bitcoin. But then comes the shock. Japan's interest rates start to climb. Suddenly, holding those yen loans gets super expensive. The free money party is officially over, and everybody, I mean everybody, is scrambling for the exit all at the same time.
All right, so how did this earthquake in Japan lead to the crypto carnage we're all seeing right now? This is where that big macro event turns into all that red you see on your screen.
And the immediate result was just brutal. $500 million. $500 million in bullish, leveraged crypto bets. Poof. Liquidated in a flash. Wiped out. That is the sound of forced selling on a massive scale.
And this is the absolute core theme of what's happening. This isn't about Bitcoin's fundamentals or some specific project failing. No, this is a deleveraging event. All that extra cheap leverage that was flooding the system, it's now being violently flushed out.
And this table just illustrates the widespread damage perfectly. I mean, look at it. Bitcoin and Ethereum are taking a serious hit. They're struggling to hold key levels. But the altcoins, they're getting absolutely crushed. And part of the reason for that is that Bitcoin dominance has shot up to 58.7%. That means capital is fleeing the smaller, riskier coins and running for the relative safety of Bitcoin.
And you know, as if the fire from that Japan shock wasn't hot enough, China decided to pour a whole can of gasoline on it. This news of an intensified crackdown just added this heavy, psychological weight to the sell-off. It created a perfect storm of fear and forced investors to really second-guess where their money was.
But here's where things get really fascinating. In the middle of all this chaos, not everything is actually down. We're seeing a massive divergence taking place, and it tells a really interesting story about where capital is running to survive. What we're seeing is a classic flight to quality. Money is pouring out of the purely speculative stuff, like meme coins, and into projects that have strong, fundamental catalysts behind them. You've got entire sectors, backed by real news and real utility, that are actually thriving in this chaos.
Yeah, this chart just captures the whole story in a single image. On one hand, you have Zcash, which is just soaring, up over 18% on very real fundamental news about a potential grayscale ETF. And an ETF, an exchange-traded fund, is a huge deal because it opens the door for traditional investors to buy in easily. Then, on the other hand, you have Dogecoin, which is slumping hard because its own ETF launch just failed to attract that big institutional money. It's really a tale of two completely different markets.
Okay, so with the board being wiped clean so violently, the big question is, where does the market go from here? Let's break down the short-term chaos versus the potential long-term picture.
So in the very near term, yeah, you're going to want to buckle up. Volatility is king right now. We're seeing veteran traders like Peter Brandt sounding the alarm. warning that this correction could have a lot further to fall. He's even talking about a potential crash below $58,000 for Bitcoin. But if you zoom out, beyond the immediate panic, the big institutions like Fidelity are actually telling a different story. They're suggesting this isn't the end of the bull market. Instead, they think this kind of extreme, gut-wrenching volatility is actually a classic sign of a final, powerful acceleration phase right before the top.
So these are the key events on the horizon that everyone is watching. First, stablecoin regulation. That would bring some much-needed clarity. Then you've got Ethereum's massive Fusayaka network upgrade, which is a huge deal for the ecosystem. And finally, the CFTC, that's the main U.S. derivatives regulator, is starting up its reports again, which will give us a much clearer picture of what the big institutions are doing. Any one of these could totally reshape the market.
And all of this brings us to what might be the most important takeaway from today's meltdown. How do you read the overwhelming sense of fear that has just gripped the entire market? Just look at the Crypto Fear and Greed Index. It's a classic way to measure sentiment, and right now, it's sitting at 24. That's not just fear. That is deep in extreme fear territory.
And that fear, it's not just a feeling on a chart. It's reflected in hard data, in real money. Bitcoin ETFs just had their worst month since February, with a staggering $3.5 billion flowing out. The money is literally running scared.
And that leads to the one question every single investor is asking themselves right now. Is this a signal to run for the hills, to sell everything and protect your capital? Or is this the exact signal that contrarian investors wait for their whole careers? A sign of maximum, once-in-a-cycle opportunity.
The source material leaves us with this really powerful, provocative thought. Right now, the board is being cleared of all that excess leverage. And it's in moments just like these, when fear is at its absolute peak, that the decisions you make are the ones that will likely determine how your wallet looks in that next phase of the market.